right, welcome everybody back to the channel, The Millennial Messiah, and we are finally on the last chapter of the reading from the book, The Lords of Easy Money. And boy, man, has this book been an eye opener from our first audio doing from chapter 1 all the way now to the very end of the book, chapter 16, learning about what money is, um, how it's used, how the Fed has destroyed its value and continues to destroy its value, and how we as citizens of America have to deal with the consequences of that, and the fact that the Fed is not even a government entity, it's its own private entity, but yet it still controls our money in this country, which makes absolutely no sense. But, anyways, we are going to continue with the last chapter, chapter 16, The Long Crash. After he was laid off from Rexnord, John Feltner was determined to keep his life on track. He and Nina had been planning for a long time to save up enough money to buy a house they'd rented near Silver Spoon Drive. The couple didn't seem willing to let go of that goal. In the first few months after he lost his factory job, Feltner bounced back and around between temporary gigs, and he got a job doing maintenance work at a grocery store. Later, he got a contracting job, also in maintenance. He had suspected that he wouldn't be able to find a steady job that paid as much as his unionized position at Rexnord. He was right, but he kept pressing, and he did eventually find a full-time position in the maintenance department of a big hospital. It paid less than Rexnord, but it was dependable. Nina had work in the human resources department of a company that provided at-home mental health care. It took some time, but they did save up the money, and they did buy their house. Also, thanks to the luck, they worked in healthcare, one of the few industries that weren't shut down or interrupted by the coronavirus pandemic. By the end of 2020, Feltner's workday started in the late afternoon. He started getting ready a little after 2 p.m. in the afternoon. When he pulled out of his driveway and began his long commute, the quickest way to get to work took about 40 minutes. The first part of the route went along Interstate 70 towards Indianapolis, past a monotonous background of farmland that was wide open and empty during the long winter months. From there, the route went north on the big highway, loop around the edge of the city to Community North Hospital, a large complex that looked like a self-contained office park. Feltner's shift ran from 3:30 in the afternoon to about 11:30 at night, when the complex was mostly quiet. The first COVID-19 case in Indiana was diagnosed at Community North on March 6th. By November, the state had about 200,000 cases and 5,000 deaths. Another 5,000 people would die in the state the following couple of months. The whole thing made life surreal for people like Feltner. The hospital eventually set up a temporary tent facility in a parking lot to conduct drive-through testing for the virus, creating the feel of emergency barracks. Feltner wore a face mask during his entire shift. His social life slammed to a halt, like it did for pretty much everyone. And Nina set up a home office in the upstairs bedroom. The couple's daughter lived at home, although her health care job took her out of the house. The Feltners stopped seeing their friends and heard through the rumor mill when the neighbors got sick. Feltner stayed very busy at work, which was a blessing in its own way. People in the restaurant and hotel businesses would be out of work for months. Feltner belonged to the group of workers deemed as essential, meaning that he didn't have the option to work from home at a safe distance from others. America's essential workers in 2020 put in very long hours and crisscrossed a largely abandoned landscape, delivering food, working at grocery store checkout counters, using their cars, staffing hospitals, and keeping factories and warehouses humming around the clock. They often did this at great personal risk, getting sick from COVID 19 at a far higher rate than workers who stayed home. Feltner and Nina were among the fortunate. They never caught coronavirus, or at least didn't have any symptoms if they did. Neither did their daughter, even though her job took her on home visits to people who did have the virus. The federal bailouts did a significant impact on these essential workers. Evictions were held at bay, and the emergency payments helped them meet bills. But the majority of the government's largest bypassed places, like the Feltner's neighborhood, the economic recovery of 2020 was a gated recovery, with the money flowing to selected exclusive zip codes. The people who did well did very well, but the rest did not. The Fed surveyed businesses with fewer than 500 employees and found that 90% of them were still suffering from a downturn in sales by the end of the year. About 30% of those companies said they would probably go out of business if they didn't get more federal aid. For Feltner, the bailouts were a marginal issue, something that they didn't matter very much in his daily life. The one-time payments mailed out to everyone didn't do anything to arrest the much longer downward slide that defined the decades of Feltner's worst working life. Before the financial crisis, he worked at the auto parts maker Navstar. Feltner earned about 80,000 a year and more when overtime pay was included. At Rexnor, he took a pay decrease and earned about 60,000. At the hospital, he had another pay decrease. He earned about 46,000, and at each job his benefits had been scaled back and his health care costs had risen. He wasn't alone in this regard. The middle class had experienced a very long and deep slide in its earning power, bargaining power, and wages. Virtually nothing had changed this trajectory during the decade between 2010 and 2020. The economy had grown, but the growth was captured by smaller and smaller shares of the population. Feltner and his neighbors weren't just excluded from the lion's share of the 2020 bailout, they had been excluded from the benefits of ZERP and QE and the asset price inflation that those policies created. The entire bottom half of the U.S. population owned about 2% of all the nation's assets. The top 1% of the population owned 31%. This helped explain why the households in the very middle of America's income scale, meaning the mid 20%, saw their median net worth rise by only 4% between 1989 and 2016. During the same time period, the net worth of people in the top 20% more than doubled. The wealth of the top 1% nearly tripled. Millions of people in the middle class were falling behind, and they still are today. To compensate for this fact, they took on loads of cheap debt, which helped them feel like they were at least remaining in place. Consumer debt hit 14 trillion in late 2019, a record level even after adjusting for inflation. The only good news seemed to be that interest rates on the debt were lower. Households were spending about 10% of their disposable income in servicing debt in 2019, which was down from 13% right before the global financial crisis. Feltner was an optimistic guy by nature. He talked about the local boom and in construction that seemed to be underway in 2020 and the fact that skilled trade workers were in such high demands. His daughter found work as a home health care aide, and his two sons also had full time jobs doing maintenance work on vehicles for a local school district. Things were pretty good at the end of the day. One of Feltner's sons welcomed a new baby during the pandemic, which helped keep everyone's mind off the gloomier realities of what was going on. But Feltner also had felt a nagging fear about his kids' future. All of them had started working when they were young, and they knew how to work hard and be dependable. But it wasn't clear anymore that hard work was a pathway to a dependable living or a stable life. Feltner didn't know if his kids could expect to earn even as much as he had earned. It scares the hell out of me. It really does, he says. It's almost like we've become the commodities ourselves. You know what I'm saying? Feltner said. The value of workers has been diminished, but the value of other commodities was on the rise. The Fed was making sure of it. Jay Powell had become a figure like the Wizard of Oz by December 2020 to most people. Powell was a disembodied face that flickered on a large screen, deliver proclamations from on high. The Fed's press conference were now held by video conference after each FOMIC meeting. The choreographed events began with an image of Powell standing in front of a large blue curtain and reading scripted comments. When he was finished, Powell took questions from reporters who suddenly appeared on the screen, each of them a small face framed within squares arranged in a large grid across the screen. The reporters were sitting in various home offices and apartments, and they spoke into awkward angled camera angles. On December 16, Powell made a big announcement. Some of the most important emergency measures the Fed had deployed during the spring would now be made semi-permanent. While the mainstream lending program was sputtering to a quiet end, other parts of the bailout would endure. The Fed would keep interest rates at zero and would now conduct $120 billion in quantitative easing every month for the foreseeable future. That was about a decade's worth of money creation at historic rates, conducted every 30 days. It would continue, Powell said, until substantial further progress had been made towards healing the economy. When that might occur was anyone's guess. Powell said the Fed would continue to intervene as long as price inflation didn't rise above 2% for an extended period of time, an eventuality that he said was unlikely in the near future. The price of certain items had spiked because of supply disruptions, but weak growth and weak demand were smothering prices all over. Asset price inflation, however, was accelerating without restraint. The stock market was doing so well in December that it didn't even make sense to the people who were making the money off of it. A web-based food delivery company called DoorDash went public that month, and its stock nearly doubled immediately. The online rental company Airbnb went public and its shares more than doubled. This might sound great for those companies, but when share prices jump so quickly, it means that the firm's original owners have lost out on a lot of money because they've priced their shares too low. A video game company called Roboxlo suspended its initial public offering in December as it tried to make sense of the market, according to the Wall Street Journal. The value of the stock market shares was as high as any time since the dot com boom. But when compared to actual company revenue, if that didn't make sense to people, then things weren't going to make sense for a long time. The market broke records and then broke them again in the months to come. The market for corporate debt was just as strong. By the end of 2020, companies issued more than 1.9 trillion in new corporate debt, beating the previous record that was set in 2017. Businesses for leveraged loans and CLOs was booming. American companies would carry this debt for many years to come because of the way it was structured. Companies had to either roll the debt by selling it again or pay it in full when the loan expired. The corporate debt binge brought a new and troubling term to corporate America's lexicon, something called the zombie company. A zombie company was a firm that carried so much debt that its profits weren't enough to cover its loan costs. The only thing that kept zombie companies out of bankruptcy was the ability to roll their debt perpetually. During 2020, nearly 200 majorly publicly traded companies entered the ranks of the zombie army, according to an analysis by Bloomberg News. These weren't just marginal or risky firms, but included well known firms like Boeing, ExxonMobil, Macy's, and Delta Airlines. When Bloomberg analyzed 3,000 large publicly traded firms, it found that about 20% of them were zombies. These companies posed a risk beyond their own financial stability. Their existence suppressed economic productivity because they consumed investments and resources that might have gone to new firms and or entrepreneurs. Powell's political standing in Washington had never been so high. His fortunes seemed to rise even higher in November when President Trump lost his bid for re-election to the Democrat Joe Biden, the former vice president. Word soon leaked out that Biden's pick for Treasury Secretary was Powell's former boss and colleague Janet Yellen. Experts in D.C. expected that the Fed and the White House would now have one of the most cooperative relationships in recent memory. On the way out of the office, Trump's administration had a final spat with the Fed. Munich, who had worked so closely with Powell, announced that the Treasury would no longer support the special purpose vehicles the Treasury and the Fed had created together, like the program that bought corporate junk debt. The vehicles would be closed down at the end of this year. The Federal Reserve opposed this move and released a statement saying as much, but Munich said that his reasoning was simple. The CARES Act specifically said that the Fed's emergency SPVs should close at the end of 2020. There seemed to be little reason to extend the program now that the markets for stocks and corporate bonds were booming. I had every intention of following what I saw as the clear interpretation of the law, Munich later said. The Fed pressed Munich to keep the facilities open in case markets reversed, but he felt that doing so would come with a cost. The downside was that some future Treasury security is going to have to go back to Congress at some point in the next 100 years and ask for these kinds of emergency programs. And I think the fact is that I was a good steward of this, and gave back the capital as the law was written. Will it be a good precedent for future Treasury secretaries? When Munich announced that the programs would close, it did not disrupt the booming market for corporate debt or stocks. Investors had seen that the Fed would intervene on their behalf, and that was apparently enough to keep them optimistic. On January 6, 2021, thousands of violent extremists laid siege to the United States Capitol. I disagree with that part with the extremists, but whatever, to each their own. Um, Inside the building, members of Congress were conducting the once formal process of counting the electoral votes that were submitted by the states. Biden had won the election handedly, but Trump did not concede. Trump alleged that a wide ranging and ever shifting criminal conspiracy had stolen the election from him. Which personally I do believe that, but to each their own. Trump's followers smashed windows, broke open doors, sprayed police officers with bear repellent, and pushed their way into the White House and the Senate chambers. So I don't necessarily agree with that stuff because I saw that, like, I watched the stuff unfold on the news, and I don't remember seeing any of that stuff. But at this point, who knows? It's in the past, and we're past it. So, and pushed their way into the House and Senate chambers, forcibly shutting down the transfer of power. For about 6 long hours, the U.S. political system hung in a suspended state. The transfer of powers resumed that night after police managed to regain control of the building and the rioters had been allowed to walk back to their hotels. It was the most effective attack on American democracy since the Civil War. And that's another thing that I hate too, is how people in books in general, like what this book is saying, is they're calling us a democracy, which that's a total lie. It's a fabricated lie. We have never been we've never been a democracy. We've always been a constitutional republic. But, you know, either way. Since the Civil War, and it marked an entirely new level of volatility in American society. The following day, the Dow Jones Industrial Average jumped 1.4%, closing at a record high. That month, millions of traders on the retail platform Robinhood helped drive up shares in a video game company called GameStop. The company's rising share values was puzzling when compared to its underlying economic health. The storefront business was suffering massive losses of customer traffic during the coronavirus lockdowns and was arguably being made technologically obsolete by internet streaming. But its stock was jumping by double digits. During a news conference in late January, Jay Powell was asked repeatedly about the possibility that the Fed was fueling an asset bubble inside of the FOMC meetings. The Fed's own experts talked repeatedly about the ways that quantitative easing boosted all asset prices, along with the stock market. Powell said that the Fed was monitoring asset prices but wasn't overly concerned. When he was pressed on the topic, he seemed almost exasperated. I think the connection between low interest rates and asset values is possibly something that's not as tight as people think because of a lot of different factors are driving asset prices at any given time, he said. Tom Honig spent the long winter of 2020 and 2021, as so many people did, in isolation. Instead of visiting his grandchildren, he saw them through FaceTime chats. Once the weather got cold in Kansas City, Tom and Cynthia spent a lot of the time around the house and rarely saw their friends. They figured out the little tricks of survival in the new world, like determining that the best time to do grocery shopping was on Wednesday afternoon at about 3 o'clock when no one else seemed to be at the store. They wore double layered face masks as they walked through the grocery aisles, which were now marked one way, and they stood a respectful distance from the cashier at the checkout counter, who wore a plastic face visor. One thing that kept Tom Honig going was the feeling that he could do useful work. In the mornings, he woke up early and read the news on his iPad. He kept up with the Fed's actions through the coverage of the Financial Times, the Wall Street Journal, and the Washington Post, among other publications. Which, personally, this is a side note, I think they're both trash. But continuing on, he spent a lot of time in his home office writing essays and opinion pieces that offered his best perspective on what the Fed and the banking regulators ought to be doing. He published some of these essays in Discourse, the online publication of the Miraculous Centered think tank, where he was a senior fellow. In May 2020, Honig published an essay urging people to think about what the Fed's actions during the crisis might mean over the long term. Emergency spending was vital to fighting the pandemic, he wrote. These policies, while necessary in the short term, place an ever larger mortgage against the nation's future income, and extending them beyond the crisis period could have significant negative unintended consequences, which they have had really bad consequences. Honig has made a similar argument in 2010 when he was saying that the United States needed to think about what it was going to do when the immediate crisis was over. Would the country use democratic elected institutions to confront its problems, or would it rely on its central bank once again? When Honig went on his long spree of dissenting votes in 2010, the Fed's balance sheet had been 2.3 trillion. That was a radically high amount by historical standards and was more than twice the size of the balance sheet before the 2008 financial crisis. In May 2020, the Fed's balance sheet was now an astounding $7 trillion and continuing to grow under the near permanent flow of quantitative easing. Honig's warnings in 2020 were different in one important way from his warnings a decade earlier. Now he could point to the historical record. In his essay, Honig compared the time period of economic growth between 2010 and 2018 with the period a decade earlier between 1992 and 2002. These periods were comparable because they were both long periods of economic stability after a recession, he argued. In the 1990s, labor productivity in the United States increased at an annual average rate of 2.3%, and during the age of ZERP, it rose by only 1.1%. Real median weekly earnings for wages and salary employees rose by 0.7% on average annually during the 1990s, but rose by only 0.26% during the 2010s. Average real GDP growth, a measure of the overall economy, rose an average of 3.8% annually during the 1990s, but only by 2.3% during the recent decade. The only part of the economy that seemed to benefit under ZERP was the market for assets. The stock market was more than doubled in value during the 2010s, even after the crash of 2020. The markets continued their stellar growth and returns. Honig wasn't optimistic about what was American life might look like after another decade of weak growth, wage stagnation, and booming asset values that primarily benefited the rich. This was something he talked about a lot, both publicly and privately. In his mind, economics and the banking system were tightly intertwined with American society. One thing affected the other. When the financial system benefited only a handful of people, average people started to lose faith in society as a whole. When they saw the biggest banks get bailed out while middle class wages faltered, it made people feel like the system was rigged, which it is. Honig argued in public speeches that this was a good reason to pursue bank reform. Over coffee at a bakery in downtown Washington in 2019, Honig said that the misallocation of resources under ZERP very likely contributed to the undercurrents tearing apart American society. Do you think that we would have had the political, shall we say, turmoil, revolution we had in 2020 in 2016 had we not had this great divide created? Had we not had the effects of the zero interest rates that benefited some far more than others? Honig asked. I don't know. It's a counterfactual. But it's a great question I would like to pose. In 2021, he sat at home in Kansas City. Honig seemed interested in talking about one issue above all. It was the need for long term thinking. He recalled a piece of advice he'd once gotten from a Swiss central banker that always struck with him, and we are responsible for the long run. So the short run can take care of itself, the central bankers had said. The Fed was supposed to be an ideal institution for long term thinking because it was insulated from voters and elections. But Honig didn't believe that long term thinking dominated the decisions of 2010 and beyond. The short run was the focal point, he said. This wasn't just a problem that afflicted central bankers. It seemed to increasingly dominate the thinking of corporations, government institutions, and the concerns of average citizens. Everyone had short term needs that make the long term impossible to look to, Honig said. This mattered a lot because long term thinking would be indispensable to confronting America's economic problems in 2021. The financial crash that had happened in the spring of 2020 was smothered so rapidly by so much new money from the Fed that most people didn't know it had happened, but the consequences of the crash were dire. On the morning of March 11, 2021, as Honig was reading the Wall Street Journal, he came across a particularly alarming story. Like so much of the important news about America's money and debt, this article carried a seemingly benign headline: Wave of New Debt to Test Treasury Market. The story explained the deep vulnerability rolling beneath the surface of a financial system that seemed to be growing smoothly. This vulnerability was not new, and it had to do with the very delicate balance on the financial seesaw of risk. The safe side of the seesaw held viable assets and that were reliable, like treasury bills. The other side of the seesaw held risky assets like stocks and corporate debt. The Fed was pumping in 80 billion a month onto the safe side of the seesaw by purchasing treasury bills, which in turn depressed the interest rates or yield on those bills, as had been happening for a decade. This forced investors to push their money to the risky side, seeking yield. Something worrisome started to happen in March. Treasury interest rates had started to climb, regardless of the Fed's intervention. There were lots of reasons for the yield to rise. Investors expected the economy to grow, which pushed up rates, for example, but the journal article highlighted another, potentially even more dangerous reason: the sheer amount of debt the U.S. government was issuing. President Trump and the Republicans in Congress had passed a tax cut in 2017 that forced the government to borrow $1 trillion every year to keep the government running. Even when the economy was peaking in 2019, when the pandemic hit, Congress approved more than $2 trillion in spending in the CARES Act alone, all of it financed by deficit spending. In March, President Biden signed a new 1 trillion rescue package. This was heralded as the first major rescue bill in decades that steered the majority of its spending to poor and working middle class people. All of this meant that the U.S. Treasury would be selling about 2.8 trillion in treasury bills during 2021. The journal article documented the doubling fact that there might not be enough demand for all that debt to keep Treasury interest rates down at the low levels where the Fed had been pushing them. Demand was worryingly soft during a couple of Treasury bill auctions that month. Analysts believed that there might be a buyer strike for some Treasury bills, which would require the government to pay higher interest rates to entice buyers. If Treasury rates rose, all that investment cash on Wall Street would be enticed to move towards the safe end of the seesaw, finding shelter in the higher, safer yields that had been denied for so long. This would drain cash out of the markets for leveraged loans, stocks, CLOs, and all the risky structures that Wall Street had been busily building for so many years. Powell and his team would then have to face a familiar choice. They could let the risky structures fall or intervene once again with more quantitative easing and emergency programs. Powell faced a similar choice when money rushed out of risky assets in late 2018, and he chose the path of creating more money to soothe the markets. This encouraged more speculation and asset inflation. Honig believed that the Fed would almost certainly once again choose the path of money creation if debt prices rose and markets teetered. You see the complications we're building for ourselves going forward, Honig said. Honig kept turning out his essays and his white papers. He was 74 years old at the end of his career. His ideas didn't seem much more popular than they were before. His papers were not read widely. He was rarely invited to speak on cable news shows, but Honig's arguments were as relevant in 2021 as they were a decade earlier. This didn't reflect the consistency of his views so much as the intractability of America's long-term problems. In many important ways, the financial crash of 2008 had never ended. It was a long crash that crippled the economy for years. The problems that it caused went almost entirely unresolved, and this financial crash was compounded by a long crash in the strength of America's democratic institutions. When America relied on the Federal Reserve to address its economic problems, it relied on a deeply flawed tool. All the Fed's money only widened the distance between America's winners and losers and laid the foundation for more instability. This fragile financial system was wrecked by the pandemic, and in response, the Fed created yet more money, new money, amplifying the earlier distortions. The longest crash of 2008 had evolved into the long crash of 2020. The bills had yet to be paid. All right, that was the end of the Lords of Easy Money. And as we know, unfortunately, the Fed is still, to this day, printing out more and more money and devaluing our currency more and more. And we see the effects of it every day, as every day and every week it seems like grocery prices are getting higher. We're being able to purchase less for the same dollar. Wages are not increasing faster than inflation. So it is our duties to learn as much as we can about money, how to build businesses so we can ultimately make better lives for ourselves and our future families, because unfortunately the tax code, tax laws, and everything are meant to benefit businesses and business owners, and we need to do our best to learn and grow together. So thank you all for tuning in and listening, and I hope you all have a wonderful rest of your day. Goodbye.